is going, and it's my first one, so everyone will just have to bear with me. I'm hoping that there'll at least be a couple of nuggets that come out of this presentation, and if nothing else, if it sucks, you all get to click on a raging emoji afterwards, and then I'll know how to do better next time.
You will be fine, Christopher. We're shushing. Go for it.
Okay, so I want to cover a few topics today, and I want to sort of look at investing and managing money from my experience and my point of view. And so to start off with, I'm going to give you a little bit of context around who I am, just so everyone understands my position and where this comes from. And then we'll move into money management, which is such an important thing when it comes to investing. We'll go into that in a bit more detail once we get through this agenda, and then just a light touch into investing in a way that I feel will get people to be able to sort of dip their toes and take a step forward, and then where to after that. So my name's Christopher Mills, and I'm just a normal person. I grew up in a normal household. Financial conversations and money and things were not topics that were discussed, and nor was there an abundance. And what happened to me was I went through normal schooling as a normal chap, playing normal sports, went to varsity, dropped out of varsity, started working, and realized that my parents hadn't provisioned correctly for themselves, and that I actually needed to make a difference by learning what I could. And one of my earliest memories was I saved up an amount of money, and I don't think the numbers are too important, but it wasn't a drastic amount. I would have been able to squeeze out an older secondhand car, to give you an idea, and that's all the way back probably in 2000, 2002 maybe. And I approached sorry, there's some people joining. I approached a family member who was far more successful than my parents and things, and I said to him, you know, I've got this money, it's sitting in my bank account, and I've done some reading, and I know there's more than I could be doing with it. And unfortunately / fortunately, his response was almost, it's too little for me to really help you with. And I was very deflated by being told that, but at the same time, I realized I need to do something myself here. If I'm going to run into walls like that where it's not enough, I'm going to have a problem, because at that point, there was a huge amount of money that I'd saved up. I saved up by delivering pizzas for Butler's Pizzas, for those who are in Cape Town. And so it was a big amount. And so I went on this journey of what is probably now close on a decade, if not a little bit more, and just trying to understand, how do I better manage my money? How does debt work? If I go into debt, be it good debt or bad debt, how do I come out of that? But then I wanted to know, how do I make my money make more? If I've got 20,000 Rand, you know, how do I make that into $1 million in a year? And that's sort of what I thought it was. I saw all of these fancy people online who were saying, you know, you take your money and you can 50x it if you put it into this sort of scheme. And I was lucky enough to know that if it sounds too good, it probably is. And so that started this journey. And I spoke to a number of friends, colleagues, professionals, highly educated people. It just became obvious that for me, and it's not for everybody, for me, I needed to be able to control some of this myself. And in order to do it, I needed to understand. To the same extent, speaking with professionals back then, I needed to understand what they were saying to me when they used all these fancy terms. And so I went on this journey, and it became an obsession, which was fueled by emotions and fear of repeating some of the things that I went through as a child, but also to empower myself and put myself into a position where I felt confident in what I was doing. And to sort of close that off, that turned into something where friends and colleagues and staff members would come to me and say, hey, Chris, you got a bit of an understanding of this stuff, you know, help us, you've learned it. And I've helped a few people along the way, which I know has worked out well for them. And it gives me an incredible feeling knowing that I can share some of the knowledge that I've built up. And that's what's led me to starting 100 MPM, just this way to give back to people and empower them and educate them and help them reach a certain level of wealth that's good for them. But I'm not a financial advisor. So, you know, what I'm sharing today is very much based on my experience. And I always do need to caution legally, but also for just the way I feel is people do need to do their own research, and you do need to speak to a professional. And that's really important. So what I'm going to share today is to reiterate my experience, how I see things through my life and where I want to take my life. And, you know, where I want to take my life is very different. There could be someone listening who wants to get to a point of owning a yacht that's docked somewhere in Spain. That's not my ambition. It was for a long time, and then it changed when family and I got old and things. Then that priority sort of changed. But then there could be someone sitting who really wants to get to a point of retirement at a very young age, and they're willing to do so without glitz and glam. So everyone's got a different goal in mind that they want to work towards. So take what I say today more as just getting a bit more familiar with the terms that are used and things like that. Okay, so let's start getting into this. When it comes to money management, I listened to a fantastic podcast yesterday where the two gentlemen were talking about they've started doing CrossFit because they're getting older and they want to get a bit more in shape, and they do a podcast on money and life and things. And the podcast was entitled something along the lines of going CrossFit on your finances. And I thought that was really great, and it resonates with me. I'm someone who really watches my money very closely. I'm very aware. I could probably say what the last 10 transactions were on my personal bank accounts and things like that. And that speaks to this idea of even a small thing can damage something that could be great. And what's important about this is that we all want to jump into the investing part, and what is really glorified to be this really exciting part of money where you can make a lot of money. But the honest truth, and I know a lot of people hate this, but the honest truth is we have to step backwards to go forwards a little bit. And that's by looking at topics such as budgeting, debt, emergency funds, and increasing your income. And by going through some of these processes, we can free up income, or we can reduce the amount of money we're repaying to the bank in the form of interest on a debt. Or if something goes wrong in your life and you need cash to pay for something, you've got an emergency fund and you don't have to dip into your investments. Or you're in a position where maybe you could get a promotion, maybe you could start a side hustle. And that's the first thing I want to approach. And I think it's really critical. Sorry, let me just see. Oh, I'm gonna have to jump out of presentation mode to view the chat. So I'm dodging that one. Apologies. So when it comes to budgeting, we really need to know where we're spending our money. There are all sorts of different rules. There's the 40, 30, 30, the 50, 40, 10, where we break it down into wants and needs and love to haves and things like that. And we can get quite scientific around that with pie charts and things like that. But at the end of the day, I think it's more important to know where we are actually spending our money. We need to have an understanding of things such as how much is our rent. And I know that sounds funny because most people do have a good idea, but I've spoken to many people who are quite lost in terms of, you know, where they're really spending. So we want to know where our rent is. We want to know where our car repayment is, or our bond, or our medical aid and things like that. But the part that I've always found tricky is we often know what those are, but we don't know what the smaller amounts are. How much are we spending on our day-to-day consumables? Are we someone who walks down the aisle at Checkers, Pick and Pay, Woolworths, and we grab that item in that lovely final aisle leading up to the tills? And how many times are we doing that? And did we know that actually amounts to 200 or 300 Rand a month? And if we can find 2 or 3 of those were suddenly up to 1,000 Rand a month. And if that money could be used to pay down debt, build our emergency fund, then we're getting closer to the investing part. And if we have no debt and we've got an emergency fund, that 1,000 Rand could go into an investment account. And I'm going to talk about that in a couple of minutes. And I've got some examples. So we want to get a really great idea on how we're budgeting. And at the end of this presentation, I've got links to an expense tracker that I've built that will help you break your money down to understand where you're spending your money. But on a personal note, I started a Google Sheet or Microsoft Excel sheet many years ago, where for 3 years, I tracked every cent that I spent. And I really mean that. I mean, if I went somewhere and there was a gentleman looking after my car and I gave him some money afterwards, I wrote that down. Every single thing I wrote down. And I did it for a number of years. And what happened was I stopped needing to use the sheet because I got such an intimate understanding of where my money was going. And it was almost as though I did have that pie chart in my mind where I knew that 30% went here and 20% went there. And that, I can honestly say, was one of the biggest and best decisions I ever made. I really understood where my money was going. Now, moving on to debt. I am by no means a debt expert. I know that debt is bad when it's consumer debt, accounts at shops and things like that. We don't want that. And the amount of interest that they charge on those accounts these days is ferocious. And, you know, to be honest, I think it's really wrong, but it is what it is. But we want to get rid of bad debt. You know, if you've got a bond on a house, that's not a bad debt. But if you've got a clothing account or something like that, we really want to try and find a way to get into that debt and get rid of that debt. And honestly, if it means cutting down on some of the wants every month to start killing off that debt, that is absolutely crucial. You're going to have to dodge that aisle at Pick and Pay or whatever that's got the sweets and chips and fun things. I don't know, put a pair of headphones on and distract yourself, but take that money and rather pay it into your debt, because the debt is going to just eat at you in a negative sense, versus when we get to investing, we're going to build and build and build. Emergency funds is a topic that, you know, if you've ever come across anything to do with personal finance, you know, if they don't talk about emergency fund, I question the credibility. An emergency fund, in short, is just a pocket of money where you've saved up 3 to 6 months of your salary. So if you had to lose your job, or if you're a contractor and you lose your contract, you know that you've got a runway of 3 to 6 months to carry on living how you live while you make a plan. To the same degree, if you've got a car and you have an accident or a problem with your car and you don't have insurance, for example, you can dig into your emergency fund to pay for that expense. And the purpose there for me is twofold. One, it prevents you then from going into debt in a situation like that. But two, it means that if you are investing and something goes wrong, you don't have to pull money out of your investments. And that latter one is crucial, because there's so much psychology behind investing. You have to look at the situation where you're putting money away on, let's say, a monthly basis. And that's hard to know. I'm going to just put money away, just put money away, and I'm never going to take out of it. When you get that right, the last thing you want is a problem in your life where you have to take out some of that money, because it's like going on a diet and you start eating, and I know this really well, and you stop eating chocolates and chips and sweets and things. You go for a couple of months, and that one day you get weak and you eat that chocolate, and the next day you have another, and the next day you have another. It's the same thing in my experience with investing. When you start pulling money out, it is incredibly difficult to stop and rebuild that. An emergency fund protects you from that. Now, the last one is, you know, your income. And that is a reality for a substantial number of people. If you are getting 10,000 Rand a month and your costs every month are 10,000 Rand, you know, you're breaking even. And there's nothing you can do. If you're frugal and you're careful, there's nothing you can do. And you might need to look at, is there a way to get a promotion? You know, can I go to my superior or my boss and speak to them and tell them what I'm trying to do? I'm trying to save a little bit for my future, for my children's future, and speak to them about that to see if you can figure something out. Maybe you're a contractor and you're in a position where maybe you could charge just that little bit extra. If you're currently in an engagement, you could speak to the person. And, you know, I take a really big, strong stance on this concept of we're all human beings at the end of the day. I don't care if someone drives a Ferrari or the next person doesn't. We're just human beings, and speaking openly to people can actually get you really far. You have to gauge that for yourself. Job changes, that's always one that gets talked about. It has been proven that moving from job to job to job presents you with this ability to more than likely jump up in your salary as you go forward. I'm not advocating that as a business owner myself. I want to retain staff, so I'd hope they'd come to me with point number one to try and see what we could do, and that's happened in the past before, and it's worked really, really well. But depending on where you're at, you might have to job hop a while and try and get yourself up 5 to 10% each time, especially with what's going on in the economic climate at the moment. And finally, a side hustle. And I think everybody here has some level of interest in money, and more than likely has been on some social media platform, and you would have heard side hustles. And yes, social media sounds really easy. All you need to do is find a product, look up the price on Amazon, put a markup on, and Amazon will drop ship it for you. In the next minute, you'll be making $20,000 a month. Social media makes it look really easy. It isn't. But what I see as a side hustle might be something as simple as going around in your neighborhood, offering to power wash a driveway, for example, or maybe it means starting a blog or something where you can publish information and have links to websites where if someone clicks on them and makes a purchase, you get a kickback for that. But this is dependent on where you're at. If you're breaking even every month, you need to either scrutinize your budget if you can, or you'd need to look at the promotion or job change. If you're someone who's got a surplus every month of a couple $1,000, then you should be topping up and building your emergency fund or paying down debt. And if you don't have that, that's amazing. And then you can move into the investing side of things. And so investing is boring. And really, if you want to do well at it, I would say you need to get used to it really quickly. The media makes it sound like glitz and glam, and we hear the commentators on CNBC talking about Tesla going up 50% and crypto going up this and that and this and that, and it sounds like you just throw your money at it and you're going to make all of this money. But it's been shown time and time again that investors like Charlie Munger or Warren Buffett and a whole lot of them who are very cautious, slow and steady, tortoise wins the race type of people, and they've come out ahead. Anyone who jumped in following Cathie Wood and all of her ARK Invest ETFs around genomics and EVs and all of that will have been going, Warren Buffett and Charlie Munger are old. They don't know what's going on anymore. The world has changed. And now they're sitting there going, oh, dang, Tesla's down like 60% and is trading at what it was 3 years ago. And, genomics hasn't taken off in the ARK Invest ETFs. And once again, Warren Buffett, Charlie Munger, and their contemporaries are sitting there going, you see, let's just be consistent. Let's invest often, and let's invest into great companies. And so I think that's a big lesson today. I'm not going to teach you how to get rich quickly, because there isn't such a thing. And anyone who's got rich quickly has taken 15 years to get to that point. So moving into investing, and this is such an enormous topic, and it really is overwhelming. When I think about the amount of information I've acquired over the past 10 years, and I'm still learning every single day, and I think about trying to learn all of that in a short burst, it's not possible. So we need to look at, where do we start when it comes to all of this? And I want to talk about tax-free savings accounts today as our sort of like, let's dip our toe and let's take our first step into this. So overwhelming, and it is. You know, if you speak to anyone who has an idea of what's going on with finances and investing, they'll talk about terms. You know, we've got property, we've got real estate index funds, we've got ETFs, TFSAs, retirement annuities, provident funds, unit trusts, the S&P 500, the JSE. There are so many different options. And I think one of the biggest problems is that this is overwhelming. And I've been there. I relate to this. I relate to it to this day, even after all of these years, where I'm like, gosh, okay, where do I actually start? And then if I start, do I put it all into one thing? Well, I read this thing about diversification, but then there's diversification again across asset classes. There's geographical diversification. There's currency diversification. And it gets so super overwhelming that what I want to do today is I want to talk about just one vehicle and a great place to start, and one that has really great performance. So let's jump into tax-free savings accounts. So a tax-free saving account is effectively a place where you put your money, and any growth that comes from that investment is not taxed. It's hard to beat this. When you look at how much tax is in South Africa specifically, it's considerable. So if you can put your money somewhere where it grows and you don't get taxed on it when you take it out, you're probably going to struggle to invest somewhere else where the growth is greater than the taxed amount so that you can skim off the top. It's possible, but you really have to know what you're doing then. And that's not a 101 course. That's more advanced. So for most people, we need to look at a tax-free savings account as a great stepping stone. So just some important points about a tax-free savings account. We can invest up to 36,000 Rand per year into a tax-free savings account. So that is the ceiling. And you can invest up to 500,000 Rand. That is its lifetime limit. You don't have to invest 36,000 Rand a year, or the monthly equivalent. You don't have to. You can go at your own pace. But if you go over these thresholds, there's a 40% penalty in the over-contribution. So if you contribute 40,000 in a year, you're going to pay 40% on that 4,000. So you want to stick inside these limitations. So let's look at how we go about getting a tax-free savings account. And there's 6 steps. Starts with a broker, opening an account, choosing a tax-free savings, depositing your money, choosing an asset, and then buying the asset. And this gets complicated in itself, because at the end of the day, you've got a brokerage, and this is really just a fancy name for an institution where you put your money to buy this tax-free savings account. And this can be your bank or financial institution. I'm a big fan of Satrix and Easy Equities, not for reasons like they are the best or they have the lowest fees, etc., etc. They're the ones that I've used personally for all of this. I've used Allen Gray, I've used Signia, I've used 10X, I've used Old Mutual, I've used Marriott. I've been through a good handful. I've found that Satrix and Easy Equities have very easy user interfaces. Their websites and systems are very easy to use. I've found their support to be really good. I know that their fees are decent. I know that there are cheaper ones. This discussion happened on a forum the other day showing that Easy Equities would appear to be slightly cheaper than Satrix, but these are my 2 preferences. I've tried and tested a lot of them. You don't have to go with them. You could speak to your bank, to be honest, but I feel personally, if you want to dip your toes, these are good options to go for. Right, so opening an account. This isn't complicated. And I understand when we put money into an equation, it's scary to do these sorts of things. And speaking to a lot of people about this, you can imagine a lot of people in my life say to me, you know, Chris, I got to start putting money away. I've got a family now. I need to think like this. Well, where do I start? What do I do? And I'll say to them, you go to somewhere like Satrix or Easy Equities, open an account, deposit your money and buy. And they look at me and they're like, come again? And they'll go away and they'll go to the website and they're very scared. it's almost as though, am I putting my money in a safe place? How do I know it's not going to vanish? And I get that I'm in the 40-year-old category here, and I'm a little bit old school, and so are most of my friends, and that's scary compared to the youngsters who've grown up far more digitally. But at the end of the day, it really isn't complicated. And going to satrix.co.za and clicking on the sign up button at the top right presents you with a very simple form. And I've got this on a page on my website that I'll share with all of you. Clicking sign up, filling in your details, going through the process of FICA. We have to do that. Once your account is FICA verified, then your account is right there and you've opened an account. You can log in and log out with a username and password, just as you would do on Facebook or any other website. Now, inside your brokerage account, so let's say that we did go with Satrix, just for ease of flow here. You can log into your account now and you've had a look around and you're feeling a little bit more familiar. I cannot stress how important it is to log into the account and take time to look around. Don't rush into wanting to put money in there or do anything fancy. Look around, click on the menu, see what options there are. Do that. I promise you it will make all the difference. The minute you put money into the system, your emotions and the psychology changes completely. So before you put money on the table, first have a good look around. Now, inside Satrix, once your account's verified, you're logged in, you literally click on tax-free savings account, and it's right there in the middle at the top of the screen. You literally can't miss it. You click that option, and that opens up a tax-free savings account for you. Now, that gets complicated. You've got this brokerage you've just opened up, and you peel away a layer and suddenly got a tax-free savings account that you've opened up. And now there's even a further sort of step to that. And that is, now we have to make a deposit. And this is scary, and I get it. Inside Satrix, Easy Equities, Alan Gray, all of them, you get their bank details. You click on a button that says make a deposit, and it gives you their bank details. You take those bank details and you make a payment just like you are if you were paying anybody else. You log into FNB, Standard Bank, Nedbank, Capitec, Discovery, whichever one it is, you enter their details in, you choose the amount you want to deposit, and you click pay. It's as simple as that. One thing that I can recommend here as important is make sure you use the correct reference number. So within your Satrix account, when you look at the bank details, you'll get a unique reference number, which is something like SX hyphen and a number of numbers. That speeds up the process. I've done it before. I've used the wrong reference number. The money doesn't vanish. You just have to get hold of them, send them proof of payment, and then they clear the funds. But your first time, that's quite scary. So use the reference number. You do your transfer, and you will receive a notification from the brokerage telling you once your money has cleared in the account. So now we've got an account open, we've got a tax-free savings account within, and we've got money sitting there, and you can see your balance in your account. Now we have to decide, what do we put in there? So just to reiterate, we've got a brokerage, we've then got a tax-free savings account inside, and we need to put something in there. We need to put the asset in there that we're buying into. Now, with Satrix, gosh, I've said their name so much, it feels like they're a paid sponsor, but I promise you they aren't. Within Satrix, there are a whole lot of ETFs. And an ETF is an exchange-traded fund. And what it is at the end of the day, it's just a basket of shares that are grouped together. So instead of being in a situation where you've got to hand-pick shares, they take a basket of shares that is predefined. And by means of an example, you can look at the Johannesburg Stock Exchange Top 40, which is a basket of the top 40 shares in South Africa. If you want to do something in the United States because you believe in the likes of Google and Microsoft and all the tech companies, you might look at the S&P 500, which is a basket of 500 shares of the top shares in the United States. And you will select the ETF. There's a whole list of ETFs inside the account. You'd select the one you're interested in, and you click a buy button. And now you've got a balance of 2,000 Rand, and you can choose how much you want to spend on it. You could spend 1,000, you could spend 500, and that's up to you. With each transaction, you are charged a fee. So I wouldn't recommend doing tons of little transactions, rather one transaction a month into one ETF to start with. So again, we've got a brokerage account, we've got a tax-free savings account, and now we've put an ETF into that tax-free savings account. And that is our setup at the end of the day. Sorry, I jumped this one. So coming back to the tax-free savings side of things and our limitations. So we can invest up to, that sounds like my maths is wrong there. That should be 3,000. Sorry, that should be 3,000 a month. We can invest up to 3,000 a month. So once a month, could buy 3,000 Rands worth of the S&P 500. You can choose to split that up, and you could do 1,500 into the S&P 500 and 1,500 into the JSE top 40. That means you're splitting your investment up into a basket of local South African shares, and you're splitting the other half up into the United States. And that's that diversification I mentioned earlier. If you don't want to put all your eggs in one basket, you can do it like that. You can split it into 3. You can even go as far as doing 1,500 Rand on Satrix and 1,500 Rand on Easy Equities, because Easy Equities has a different asset that Satrix doesn't have. So that's where this can once again get back into that difficult choice paralysis. And I would probably suggest that to begin with, don't worry too much about diversification, because it might hinder you. You might get into a position where you don't take a step forward because you start questioning yourself. Wow, okay, how do I separate this? Because there's an ETF for emerging markets, there's an ETF for developing markets, there's a property ETF, there's an industrial ETF, there's a financial ETF, and you go, okay, well, I don't know which one to go for. So I would probably say, if it was me, I'd open a Satrix account, open a tax-free savings account, and the asset that I'd put in there would more than likely be the JSE top 40, the S&P 500, or what's known as the Satrix MSCI World ETF. And so that's an ETF that takes shares from around the whole world. And therefore, one could argue that it's quite conservative versus the S&P 500, where you're putting all your bucks into the US, and the markets aren't doing so well there at the moment, for example. So what I can share is that for my son, who's obviously very important to me, I went Satrix tax-free savings account, certain amount of money on a monthly basis that goes into the Satrix MSCI World ETF. So if I'm doing it for him, you know, that says a lot. That's just a reminder of our limits, and I got the math right on this one. So that's where we stand. So let's look at just a scenario here, because I think it's really important to understand where this can lead to. If we're thinking about putting 500 Rand away per month, and you think to yourself, okay, well, you know, after a year, I'll have 6,000 Rand. After 2 years, I'll have 12,000 Rand. Okay, I can see how it can get there. But what that equation and what that math in my mind hasn't done is it hasn't taken compound interest into account. And I'm not going to explain compound interest today. I've written an article about it, and I can link to it. I think it's a topic that should be read very carefully, or explained by someone who has a great deal of insight. I don't want to explain it my way and find out that it doesn't connect and that it's misunderstood. But essentially, what it is in a nutshell is, as you put your money away and it accrues interest and grows, and you reinvest that growth, you're then getting growth on top of your growth, and then growth on top of your growth on top of your growth. And over a number of years, when you look at the chart on the right, we can see how that has that exponential movement upwards, rather than just a straight line that goes from the bottom to the right and upwards. And so I wanted to give you 2 examples. And one is, if you invest 500 a month for 40 years at an interest rate of 6% return, which is quite conservative. The S&P 500, for example, has returned 10% per year on average over the last sort of 40 to 60 years. But let's be conservative here. and each year you increase your deposits by 6%. So in other words, for the first 12 months, you're spending 500 a month. Then for month 13, for the next 12, you're doing 500 plus the 6%. So you keep up with inflation. And the outcome of that is just shy of 2.5 million rand. I mean, that's a huge amount. And I get 500 rand a month is a lot. But if you can carve that out by getting a promotion or not buying those things in the aisle, etc., that is a good amount of money that you can save up over the 40-year period. And it's tax-free. So at the end of the day, that 2.5 million rand belongs to you. You're not having to pay your growth part over. The last thing I want to show you just on the right-hand graph is the green is the deposit amounts. That's how much you're paying every month. And you'll see they increase over time because of that annual increase. But the more important part there is the accrued interest and compound interest. And you can see that after the 4 years, the interest you're making is more than the amount you're depositing. And that right there is why compound interest is so critical and so important to understand and to leverage and take advantage of. Scenario 2 is looking at 500 rand per month for 30 years, because it's great to look at 40 years, but I look at myself and I'm 40 years old and I add 40 years onto that. I'm like, gosh, I don't have that sort of time horizon. Maybe I've got 30 years, you know, if I'm lucky. And then we look at 500 rand a month for 30 years, same interest rate, same annual inflation of 6%, and the outcome is 1 million. Now, going back to what I said right in the beginning, this is really dependent on who you are, what your aims are, what your current position is. And that's why personal finance and investing cannot be done in a way where I can tell you what to do. You have to solve your own equation, and you have to talk to a professional that can help you look at all these scenarios and figure out what's right for you. But the important thing for me was to show you that for 500 rand a month for 30 years at a conservative return will get you out at the end with 1 million rand. That is tax-free. Now, if you look at the graph on the right and you recall the previous graph, you'll see that the momentum isn't as great. And therefore, the accrued interest, being the orange bars, are very much the same as the deposit amounts. And that's because we've had a shorter time horizon. So the secret here really is to start doing this as soon as possible. If we start today or tomorrow versus a few months from now or a year from now, it has a considerable difference on how much you're going to have to invest every month, because you're going to be playing catch up. And I looked at equations the other day, and I've got an article up that's really a great read on how to invest for your child. Now, if your child is below the age of 10, for example, or not born yet, and you start investing right from the beginning, it is phenomenal what you're able to do when you've got such a big time horizon. Most of us only wake up to investing by the time we're 30, if not late 30s, early 40s, when families come along and our bodies change and we realize, oh, grief, health and saving are actually really important. So we normally only have 20, 30 years versus someone who arguably has 60 or 70 years. It's phenomenal how much that accrued interest takes over on the graph. And you're able to literally set someone up to never have to save or invest themselves because you've done it for them. Okay, so what comes after this? You know, we've talked about money management. We've talked about debt, and we've talked about emergency funds and how to go about setting up to a certain degree to allow us to graduate into investing. And we've looked at, now that we can invest, what is a decent vehicle to start with. And we've looked at tax-free savings accounts at a brokerage, and we've talked a little bit about the ETFs and how we put that asset within the tax-free savings account. And we've looked at examples of how our money can grow. But people are very much in a hurry to try and see these massive returns. And I wish I could sit here and I wish I could say to you, you know, I know the secret here, that the secret is to open up an offshore account that's over here because the interest's different, and we move our money in by going through a cryptocurrency and across the da 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 da. But the truth is, either that sort of scheme is actually illegal because you can't move money around like that, or it's more than likely a too good to be true scenario. So I have to come back to recognizing that investing is boring, and putting 500 Rand, 1,000 Rand, 5,000 Rand, whatever it is a month, putting away each month, that really what this is about. When you get to a point that you're putting away enough money on a monthly basis into safe, proper, valuable investments, and you've got extra money, then you're in a scenario where you should be able to start playing around. I'm a firm believer that if you don't have those mechanisms in place, those safe investments, you probably shouldn't be looking at cryptocurrencies. And it pains me to say that because I love cryptocurrencies, but really you shouldn't, unless you're going to be someone who's obsessed with this investing thing. That's different, because then you're in it, you're committing the time, you're monitoring on a daily basis, but it's tiring, and not everyone has that. So my advice is, get this done first and make sure that that money is going away every single month. It doesn't feel sore to put it away. It doesn't affect your living to put it away. You've had a problem and you've had an emergency fund, so you haven't had to touch the investment. So you've walked that journey, and that is moving well. At that point, I would say the next step, and this is me very much ignoring things like life insurance and things like that, because that's all really important too, but that's a topic for another day. But at that point, we can look at things like cryptocurrencies, or we can look at things like buying individual shares, and we can move into those. Now, all of those are far more risky. And that is where you need to know that if you're putting your money into those, that you could lose them. You could lose your money. And if you lose your money, you need to be okay. So I often say, if you're someone who enjoys going to the casino, and you know that if you go to the casino with 500 Rand, you're probably going to lose that money. And when you're heading home from the casino, are you going to feel really upset about losing that money? Is it going to prevent you from putting food on the table, paying for a child's education, investing into your normal value investments? If it's going to cause a scenario like that, don't do it. And the same thing goes for the more risky investing. And so for today, and what I entitled this webinar as like an introduction to investing, I didn't want to get into the depths of getting a brokerage where you can trade, where you can leverage, where you can look at technical analysis and all of that, because I felt that would be incorrect of me trying to think that within 20, 30, 40 minutes, I can take someone who is at the beginning and get them to a point where they know how to buy shares on an open market at the correct time that the New York Stock Exchange or whatever is open. So I've decided to leave that for today, and I'll do a second webinar on that topic where we sort of dive in a little bit more, and we can do some live purchases and things like that. But that brings me to the end of our sort of 101 crash course today. Okay, so let's leave it there. I really, really hope this has been beneficial for everyone listening. It's been a gold bucket list for me, probably for about 5 or 6 years. So I'm sitting here flippin' elated and stoked that you all took the time out of your days to come and join me.